Hello and welcome to our next discussion for government not-for-profit accounting. This topic is fund accounting and specifically the classification of funds. So this is early on in your coverage of government not-for-profit accounting, one of the very first things you learn, one of the earliest chapters. And before we move much further, we have to be able to identify what funds do we have and how do they fit into the below three classifications. So that's a key element of fund accounting, which in itself is a key element of government and not-for-profit accounting. So the three categories that we have here are government funds, or governmental, proprietary funds, and fiduciary funds. We're going to see how each of the fund types fall into these classifications. So with governmental funds, the easiest way of saying this is when the government is acting like government, which sounds like kind of an unusual demonstration or description there, but we're talking about the types of things, types of services that you would normally expect a government to provide. We're saying they're not acting like a business here. They're providing a normal governmental coverage, governmental service, and so really the best way to describe a governmental fund is that it's not a fiduciary fund or a proprietary type fund. Anything that does not fit into one of those other two fund types would fall into the governmental type funds. So we're going to see the different fund types that we have. Now, I have one mnemonic for this, but I don't have really a mnemonic for the other two types. So we're going to talk about this. We have the general fund, which is the one fund, and we'll see details of each of these, by the way, in later slides. But it's the one fund that every type of governmental entity has to have. They may or may not have some of these other fund types, but everybody has to have a general fund. So the general fund, the revenue funds, most commonly referred to as special revenue funds, service funds or debt service funds, permanent funds, and project funds, specifically capital projects. Now the reason I have some of these alternative names on the side is so that we can get some sort of mnemonic out of this. GRSPP, so it's kind of like grasp. Of course, you have to stick the A in the middle, but otherwise it's grasp. If you just look at it, it looks kind of like the grasp. So you can grasp the governmental funds. Not the best mnemonic, but at least it gives you an idea because it's the biggest fund type, and it's the best mnemonic that I can think of to identify those. So we're going to talk about each of those individual funds in just a little bit, but before we get any detail on those, we need to look at fund categories in general and what type of basis of accounting they use and what measurement focus they have. So each fund category is going to have a certain basis of accounting and a certain measurement focus. What we're going to find is that the governmental funds are different than the other two classifications. Under the governmental funds, they use something known as modified accrual, which we're familiar with accrual-based accounting from just financial accounting courses, but this is slightly modified. Now, what I will mention is the other two types use full accrual, so it's similar to what we would look at from our financial accounting background, but the governmental funds use modified accrual. So this means a couple of things. First of all, revenue is recognized not necessarily when it's earned. It has to be both measurable and available. Available could mean that it's been collected, or it could be collected anytime in the next 60 days in the next year, basically. But if it's collected, or if it's expected to be collected after 60 days, then it's not going to be considered available to pay this current fiscal year's expenditures. Because generally speaking, if you have expenditures for this year, we have to pay them off within 60 days of the next year. They won't let us go much further than that generally. So that's the rule here. It's either collected this period or it's available or it's collected within the next 60 days of the next period. So in other words, the 60 days at the beginning of the next period. If it's not collected within the next 60 days, then we're not going to be able to record it this year. Instead, we'll report it when the cash is actually collected. So we kind of revert to cash basis if it violates this rule here. That's the modification of accrual, is that it's either collected this period or it has to be collected within 60 days of the next period. Otherwise, it's just not going to be reported under the accrual basis at all. It'll be cash basis for that particular revenue. Now, the other big thing with the governmental funds is we no longer use the term expense. Instead, we use the term expenditure. Expenditure means that we've bought something. We've paid the cash for it, or we at least owe the cash for it, but we're not necessarily reporting things when they're incurred. It's not quite the same thing. So instead, we record it when the liability that relates to it itself is set up. But the other big thing here is that we do not record a long-term debt. So even though long-term debt we're going to have to pay back at some point in the future, there is a liability, certainly, but we're not going to count that as an expenditure. Now, again, I want to reiterate, when we're talking about these governmental funds, we no longer use the term expense. It's not that same accrual-based expense. It's an expenditure. And one big thing with that is that we report, let's say, inventory or supplies when we purchase it. We report salaries when we've paid them. So that's basically what we're talking about here. The insurance would be reported when we buy it, things like that. Again, though, we don't report long-term debt, and as we'll see below, we also don't report long-term assets, because the measurement focus, in other words, what we're concerned with measuring for governmental funds, is current financial resources. In other words, what do we have? What assets do we have that can be spent to pay something off or buy something? Obviously, a fixed asset, you can't really spend it. A long-term investment, you can't really spend it. It's tied up. The money is tied up. You can't use it to pay off something this year. So we don't report the fixed assets. We also don't report the long-term liabilities. So now let's take a look at each of those types of funds. The GRASP funds, the governmental funds. The general fund is the fund that all governments must have. It's kind of the catch-all. If it doesn't fit specifically into another fund, you record it here instead. This is just the ordinary operations of the government. It's when you have the resources coming in from taxes or other general revenues that are not tied to any specific project. Now, that's one thing to keep in mind here. We'll see this in journal entries in later videos, is that the general fund can interact with the other funds. Quite often it does. Something starts off in the general fund and then it moves to another fund, or vice versa. But this is basically where the general type items get reported, if there's nothing specific that needs to be tracked elsewhere. The special revenue funds. So, special revenue really tells you everything there is to know about it. It's set up when there is a specific revenue source that is supposed to be used for a specific purpose. Now, I want to mention that if it's not required to be put somewhere else. There are some of these classifications that you could argue one particular transaction type could arguably fall into two or three or four of them. Well, two or three of them, let's say. And we'll see some of those later on. But here, just a general rule is that if you set up an account to handle revenues from specific tax revenues or other streams that are committed to a specific purpose, this is where you'll track it. Now, the debt service funds, this is where you're putting money. Again, this could transfer out of the general fund into the debt service fund. It's where you're trying to track the money that you're setting aside to pay off principal or interest for general obligation debt. So you're just tracking the money so you know you have it there. You're going to pay the debt off with it. That's what this account's all about. Permanent funds, think of an endowment. When you hear about some of the big universities that are endowments, it's a permanent amount that itself is never intended to be spent. Instead, you just spend the interest on it. The principal itself should remain the same. It's just the interest earned that can be spent each year. That's why it's called a permanent fund, because that principal should remain permanent, or at least for a lengthy period of time as specified by whoever set this up in the first place. But the key thing is the purpose of this fund is that you're supposed to track the principal and make sure it stays the same. Projects Fund, or the Capital Projects Fund, this is where you have obviously a capital project, a long-term capital asset you're in the process of building. And that's the key thing. It's still a project, so it hasn't been completed yet. So you're working on it, you're trying to get it built, and this is where you're accounting for all those resources that are coming in for that. Now, we just talked about the Special Revenue Fund, where the revenue is coming in for a specific purpose. Sometimes this is the purpose. So you might have revenue that's coming in, and it might be transferred over to this Capital Projects Fund. So that's why I say they can interact, and certainly often do. Now, I do want to mention here that this fund would be used for these situations unless there's already an enterprise fund, which we'll see later, that's set up to handle it. And we'll see how that comes into play here. So now we have the proprietary funds, the second classification of funds. This is where the government is acting more like a business. They're not acting like a government providing services that only a government would provide. Instead, now they're providing services that you could very well see in a business, just a for-profit business. So we have two types here, and these are the easier ones to remember because, again, it's acting like a business. The accounting is going to be much more familiar to you. So we have internal service funds and enterprise funds. We'll talk about those in detail here in just a bit. But first, let's look at the basis of accounting and the measurement focus. The basis of accounting is full accrual. So now we're back to what we should be familiar with from financial accounting. It's using the full accrual method. We record revenues when they're earned. We no longer have that whole availability criterion to worry about. And we now refer back to expenses again instead of just expenditures. And we record them when they're incurred. So this should all look familiar. Measurement focus is the same as what we'd see in a for-profit firm. It's called the economic resources measurement method, which means that we record all assets and liabilities. Now let's talk about each of the two types. The internal service funds. This is where you have a government that, yes, it's acting like a business. It's providing services that you might very well find in another business, but the only customers in this situation are other entities or other departments of the government. So you might have a motor pool for the city. That's the only people that can use this motor pool are city employees obviously for business purposes. You might have a central supply purchasing area. Just things like that where, yes, it's a business service, but the only customers can be employees of the government that are buying on behalf of the government. They're using the services for another department. Enterprise funds, on the other hand, they're still a business-type entity. It's a government acting like a business. But here you might have both internal and external customers. Utilities would probably be your classic example here. But you might see things like a museum, hospitals, golf courses. These government entities are providing, in fact, mainly these customers would probably be external customers, with the exception of the utilities, of course. There are going to be plenty of government employees or departments using the utilities, as well as citizens. But enterprise fund, it's acting like a business. Again, we're going to see in later videos different journal entries, different transactions, but this is just an overview. Finally, we get to the fiduciary or trust funds. Now, this is where you have a government that's acting in the capacity as an agent or just a trustee. They're not using these assets to provide their own services. They're not using them to buy something, sell something, build a road, anything like that. They're holding on to the assets, the funds, temporarily, and then they're going to pass them on to whoever was entitled to them in the first place. So they're not using them. They're just temporarily holding on to them. We have four types that we'll talk about. Pension trust funds, which when you hear the word pension, you can see that's money being set aside for retirees later on. Agency trust funds, which we'll see the slight distinction there later on. Private purpose trust funds and investment trust funds. So those are the four types we're going to talk about. But before we do that, let's talk again about the basis of accounting. Here we're back to full accrual again. And just like before, we record revenues when earned. We record expenses when incurred. Measurement focus, we're right back to economic resources, all assets and all liabilities. So now let's talk about the pension trust fund. That's the first type of fiduciary fund we'll talk about. Again, as you can see here, we have the pension funds that are being deposited by various departments of the government, whoever has employees that are eligible for a pension. This fund is holding money to cover those eventual payments to the retirees. They're investing money to generate a return. They're paying the retirees off. They're recording all the funding from the various departments. So this fund is set aside to handle all of that. Agency trust fund, so it might seem like the same basic thing. You may question, why is there a specific agency trust fund when it seems like all the fiduciary funds are essentially agency funds? It's a slight distinction, but an important one. The agency trust funds, it's where the government is holding on to money, but they should have no administrative involvement. So in other words, this government that's setting up this fund, they're supposed to be a pass-through entity only. They shouldn't be administering it all. They shouldn't be taking the money, investing it like we did with the pension fund, paying it out to certain, determining how much should go to each retiree. That should not be involved in an agency fund. They're just holding on to the money and passing it right on. That's the difference here. Private purpose trust funds, these are somewhat unusual, not all that common. But this is where we have possibly individuals, maybe private organizations, or possibly other governments donating money or contributing money to this government for the specific purposes of benefiting certain individuals, certain groups, certain other governments. But the key thing is the money is being held by the government as an agent. They're not able to use it for their own purposes. They have to follow the directions of whoever donated it. So it could be simply money deposited in order to establish a new park, establish a new walkway, things like that. Set up scholarships, that's another example. And then we have investment trust funds, which it's kind of like the idea of the pension fund. The only difference is this one fund is administering all these funds that other departments of the government have invested. They had extra money, and they submitted it to this fund for investment, so they can hopefully generate a return back. So they don't want to let their money sit idle, so they're investing it, trying to generate a little bit of return. So this particular fund is charged with keeping track of all that money. So this is the first of a series of discussions in this government not-for-profit realm, but it's key to understand these fund types before you even move forward, because we have to understand the fund type itself, the category, and each measurement focus or basis of accounting for that category. You have to understand that before you move much further into the journal entries and transactions. You need to know what fund it starts at. Now, we're going to see other lectures covering this in more detail, but this gives you a good start, and hope to see you in the next lecture. Thanks for your time.